So the company that bakes Wonder Bread and Nature's Own, they just reported that their sales are actually up.
Yeah, up quite a bit, right.
Right. They brought in over $1.5 billion in a single quarter. So, why are they quietly shutting down bakeries, slashing their shareholder dividend, and fighting a literal war in court against their own delivery drivers?
Well, because right now in the 2026 food industry, selling more bread doesn't necessarily mean you're making more money. I mean, it's actually creating this massive financial stress test for them.
And that is exactly the friction we are diving into today. So, welcome to a custom tailored deep dive, taking you straight to the bottom line of the bread aisle. We are looking at the Q1 2026 financial results of Flowers Foods.
Yeah, and we're pulling this directly from their official SEC Form 10Q
Yeah,
as well as their earnings press release.
exactly.
We're basically tracking how a legacy food giant tries to engineer financial growth when their core product is, really struggling against inflation.
hmm
It's honestly a masterclass in portfolio evolution and balance sheet survival.
It really is. And that survival tactic creates what looks like a mathematical paradox right at the top of these filings.
Oh, totally.
Because in the first quarter of 2026, Flowers Foods reported net sales of $1.572 billion, which is a 1.1% increase from the prior year.
Right, which sounds great on paper.
Exactly. You see that and you think, great, the company is growing. But then you slide your finger down the income statement to the actual profit, like the net income, and it didn't go up at all.
No, not even close.
It dropped by a staggering 20.6% down to $42.1 million.
Yeah, and that divergence right there
Yeah.
is the defining story of the consumer goods sector right now. Top line revenue is climbing, but the bottom line reality is just collapsing.
Okay, let's unpack this. It's like a grocery store where the total receipt is higher because things cost more, but you actually walked out with fewer items in your cart.
That is a perfect way to put it. Because if you look at the pricing and product mix, that went up 2.1%. So they are simply charging more for a loaf of bread.
Yeah.
But the physical volume, like the actual number of loaves moving out the door, dropped by 3.3%.
Wow. So people are basically walking into the grocery store looking at the price of, say, Dave's Killer Bread or Nature's Own and
Well,
making a hard pass.
exactly. They're trading down to the store brand, or they're just buying less bread overall.
So really, the only reason Flowers Foods showed any revenue growth is because they forced a price hike on a shrinking group of loyal customers.
Right. And that strategy has a hard ceiling. I mean, the 10Q explicitly notes that there is severe inflationary pressure on consumer spending. People are
Ugh.
just tapped out. But what's fascinating here is a piece of data that usually confuses people.
Oh, the ingredient costs.
Yes, ingredient costs are actually moderating right now. The price of the raw materials used to bake the bread isn't spiking the way it did a few years ago.
Yeah.
Yet the company's materials, supplies, and labor costs actually increased as a percentage of their sales. They jumped up 50 basis points, which just means half of 1% to hit 50.6% of total net sales.
Wait, I need to wrap my head around that. If the flour and the yeast are getting cheaper, but their production costs went up by 0.5%, the only way that makes mathematical sense to me is if their factories are running half empty.
You hit the nail on the head.
I mean, if you have a massive industrial oven that costs, I don't know, $10,000 a day to keep hot, it costs the same whether you are baking 10,000 loaves or 5,000 loaves.
Right. Are they just losing economies of scale because the volume dropped?
That is a huge part of it, absolutely. When production volumes drop, you lose that manufacturing efficiency. Your fixed costs, so the electricity, the factory maintenance, the salary plant managers, all of that is now being spread over fewer physical loaves of bread.
Ah, okay.
So the cost to produce each individual loaf goes up, even if the actual flour inside it is cheaper. But there is actually another layer hidden in the SEC filing. Ooh.
What is it? They note an increase in, quote, outside purchases of product.
Wait, meaning they aren't even baking some of the stuff they're selling?
Correct. They are buying finished goods from other external manufacturers and then reselling them.
That seems... I mean, why would a bakery do that?
Well, this generates top-line sales, which makes the revenue number look okay for Wall Street. But Flowers has to pay a markup to that external manufacturer. It severely skews their internal profit margins.
Okay, so let me summarize this. Traditional bread volume is shrinking, the factories are losing efficiency, and consumers are hitting a wall on price hikes.
Yep, that's the reality.
If organic growth is essentially dead, a massive publicly traded entity still has to show Wall Street some kind of growth. Where do they get it?
Well, they have to buy it outright. I mean, if you can't grow your own core business, you look for a category where the consumer is still willing to spend money, and you just acquire a major player in that space.
Which brings us to the Simple Mills acquisition. So, in February of 2025, Flowers Foods completed the purchase of Purposeful Foods Holdings. And for anyone who doesn't know, that's the parent company of Simple Mills.
Right.
For anyone who hasn't been down the premium snack aisle lately, Simple Mills is just a juggernaut in the natural, better-for-you category. We're talking almond flour crackers, high-end cookies, clean ingredients.
Huge brand loyalty there.
And buying that growth basically saved their top-line numbers, didn't it?
Without a doubt. Simple Mills just hit its one-year anniversary under the Flowers Foods umbrella, and it added 2.3% to their total net sales this quarter.
Wow.
Yeah, and if you look at their branded retail segment specifically, Simple Mills contributed 3.6% growth. Honestly, if you remove Simple Mills from the equation, Flowers Foods would be reporting negative revenue for the quarter.
But I want to pause here and translate the numbers on the balance sheet for this acquisition because, frankly, they are wild.
Oh, they definitely are.
They paid $846.2 million for Simple Mills. But if you look at the breakdown of the assets they actually received for nearly $1 billion, only about $1.7 million of that was physical property, plant, and equipment.
Yep. Ovens, factories, desks, $2 million.
The rest of it is entirely intangible. They recorded $367.2 million as goodwill and $355.4 million as indefinite-lived trademarks.
It's a lot of money for intangibles.
It feels like they paid $840 million just for the idea of a company, not an actual physical bakery. Did they just drastically overpay here?
It's so easy to look at those numbers and assume they just overpaid for a logo. But, in the world of consumer packaged goods, or CPG, the physical ovens are actually the least valuable part of the transaction.
Wait, really?
Yeah, I mean, Flowers Foods already owns dozens of massive commercial bakeries across the country. They don't need Simple Mills ovens. They can bake whatever they want.
So what are they actually paying $355 million for when they buy a trademark?
They're buying a 20-year shortcut.
A shortcut.
Exactly. Legacy Bread Brands, the company's making classic soft white sandwich bread, they have an incredibly difficult time pivoting to the organic, non-GMO, premium health space. Consumers are skeptical.
That makes sense.
If Wonder Bread suddenly launches a $10 almond flour cracker, the target demographic just won't buy it. They don't trust the brand for that kind of product.
Right. Doesn't fit the vibe.
So that $355 million trademark line item and the $367 million in goodwill, it isn't just a logo. It represents the immediate, unquestioned trust of the health-conscious consumer.
I see.
It represents guaranteed premium shelf space at places like Whole Foods and Sprouts that Flowers just couldn't get on their own.
Okay, that actually makes a lot of sense. They are buying an entirely new identity and a new demographic because their legacy customer is tapping out. It's kind of like buying an expensive, state-of-the-art new engine for a ship that is currently taking on water.
That's a great analogy.
But an $846 million engine requires a massive amount of cash.
And this is where the financial engineering starts to get really painful. Because you don't just absorb almost $1 billion in new debt without fundamentally changing how your core business operates.
Which we see playing out right now in their restructuring data. I mean, to pay for this new engine, they are basically throwing heavy old furniture overboard just to keep the whole ship afloat.
Yeah, the cuts are deep.
Last year, they permanently closed the Bailey Street Bakery in Atlanta, taking a $7.4 million hit in closure costs and asset impairments.
And it didn't stop there.
Right. This quarter, they recorded $1.6 million in reduction in force charges, which just means layoffs, and another $8.2 million in restructuring implementation costs.
They are actively trying to optimize their network, which is corporate phrasing for shutting down excess, inefficient capacity to free up cash. And the urgency for cash is tied directly to the debt they took on to buy Simple Mills. I mean, their interest expense for this quarter alone jumped by $5.6 million compared to the prior year.
Just paying the interest on the new debt is bleeding them, which leads to a massive move they announced in this earnings release.
Oh, the dividend.
Yes, the dividend. They proudly declared their 95th consecutive quarterly dividend, but they noted that the dividend was, quote, reset to 12.5 cents per share.
Reset.
Here's where it gets really interesting. Is resetting a dividend just a polite corporate word for a cut so they can pay off their new Simple Mills credit card bill.
It is a massive cut.
Yeah.
Historically, legacy food companies attract investors, specifically because they pay a high, steady dividend. It's the whole appeal of the stock.
Right, you buy it for the reliable income.
Exactly. But the CEO explicitly stated they had to reset the dividend to, quote, prioritize meaningful debt reduction while continuing to invest behind the brands. If we connect this to the bigger picture, it is a deliberate capital allocation strategy. It is a brutal but completely necessary survival mechanism.
Well, let's explain the mechanics of that debt, because the 10Q outlines a very specific set of financial tools they're using to manage over $1.7 billion in long-term liabilities.
A lot to juggle.
They entered into a new $500 million credit facility and a $400 million, quote, delayed draw term loan. Can we break down how a delayed draw term loan actually functions for a company this size?
Sure. Think of a delayed draw term loan like getting pre-approved for a massive home renovation.
Okay, I'm with you.
You go to the bank, and they agree to lend you the $400 million, locking in the terms today.
Mm-hmm.
But you don't actually take the cash, and crucially, you don't start paying the heavy interest on it until the contractor's literally standing in your kitchen holding a sledgehammer.
Ah, so you just hold it until you absolutely need it.
Right. For Flowers Foods, they secured this massive loan, but they are keeping it in the chamber to specifically pay off their older 2026 notes when those officially come due later this year.
So they are basically securing the life raft before the ship actually needs it.
Yes, but there are catches to these life rafts. These massive loans come with strict covenants, which are essentially financial rules the bank forces the company to follow.
What kind of rules?
Well, one of the main rules involves leverage ratios, which is a limit on how much debt the company can hold relative to its income.
Oh, I see where this is going.
Yeah, when you have $1.7 billion in debt, climbing interest rates, and a core bread business that is losing physical volume, your leverage ratio gets dangerously close to the bank's limit.
So they didn't really have a choice.
No, they had to cut the dividend to shareholders. Taking that cash and using it to aggressively pay down the debt is literally the only way to satisfy the banks and maintain their financial health.
Man. So we have a company juggling shrinking volume, a billion-dollar acquisition, bakery closures, and complex debt restructuring.
It's a full plate.
But there is a totally different, highly physical reality happening on the ground that is quietly eating into their margins. And it's all about how the actual physical loaf of bread gets from the loading dock of the bakery to the shelf at your local grocery store.
Yeah, the logistics of fresh bread delivery are notoriously difficult because the product has such a short shelf life.
You can't just throw it in a warehouse.
Exactly. You can't just put it on a train and let it sit for 2 weeks. It requires a massive, hyper-local distribution network.
And Flowers Foods uses a system that, on paper, looks like a brilliant way to keep corporate headcount low. They use independent distributor partners, or IDPs.
Right, the IDP model.
Instead of hiring thousands of delivery drivers as employees, giving them health benefits, and buying a massive fleet of trucks, Flowers sells the distribution rights for specific geographic routes to independent contractors.
Which saves them fortune and overhead.
But here is the kicker. The drivers usually don't have the cash to buy these routes outright. So Flowers Foods acts the bank. They actually finance the routes for the drivers.
It's a huge operation.
The 10Q shows the company is holding about $108 million in long-term notes receivable just from acting as a lender to their own distributors.
It's an incredibly complex ecosystem. They finance around 2,500 of these independent partners.
That's a lot of drivers.
Yeah, and from a corporate finance perspective, it shifts the burden of truck maintenance, gas, and labor costs entirely onto the driver, who is theoretically running their own small business.
Meanwhile, Flowers earns interest income on the loans they gave to the drivers to buy the routes in the first place.
Right. But acting as a bank for the people who deliver your product creates a massive legal trap, which is playing out in real time in the legal proceedings section of the 10Q.
Yes, because Flowers Foods is currently defending 11 different lawsuits from these exact same distributors. And the core allegation across the board is misclassification. The drivers are basically arguing, look, you hold the note on my route, you tell me what product to deliver, you tell me exactly when to deliver it. I'm not an independent business owner, I am an employee, and I should be protected by the Fair Labor Standards Act.
The irony is pretty stark. I mean, the company designed a system specifically to avoid the costs of having employees.
Right.
but the level of control required to ensure the bread actually gets to the shelves fresh, well, it blurs the legal line of independence. And courts are increasingly siding with the drivers in these types of modern logistics setups.
Really?
Yeah. 7 of these 11 lawsuits are actually seeking class or collective action status. So it's not just one disgruntled driver, it's entire regions banding together.
Now, and we aren't just talking about hypothetical legal risk here. This is costing them millions of dollars today.
Real money.
The filings highlight a specific lawsuit, Martin's versus Flowers Foods in the Middle District of Florida. On April 29, 2026, the company agreed in principle to settle this single case for $11 million.
Just one case.
And that $11 million went straight onto their income statement this quarter, hitting their selling, distribution, and administrative expenses.
And this raises an important question, because that $11 million is just the tip of the iceberg.
What do you mean?
Well, if you look deeper into the balance sheet, the company is holding $41.1 million in self-insurance reserves, which includes their own estimates for pending claims.
Oh, wow. So they know it's coming.
Exactly. They have millions more accrued specifically for legal settlements. This forces us to really reevaluate the entire IDP model.
Because it's not a one-off anymore.
Right. Legal settlements are no longer a rare anomaly for Flowers Foods. They have become a systemic, recurring cost of doing business. The money they save by not having employees is increasingly just being spent on class action settlements.
It is wild to think about the sheer amount of corporate maneuvering baked into a single purchase. I mean, the next time you, the listener, grab a box of Simple Mills crackers or a loaf of Nature's Own, you aren't just paying for flour and packaging.
No, not at all.
You are paying for a massive web of debt financing. You are paying for the amortization of an $800 million trademark. You are paying for the closure of an outdated bakery in Atlanta, and you are helping fund an $11 million legal settlement with a delivery driver in Florida.
It really is an absolute marvel of financial engineering. They're just trying to keep their head above water in a brutal macroeconomic climate.
It perfectly illustrates the burden of the legacy food company today.
Yeah, you simply cannot stand still. If you aren't aggressively buying new revenue streams and ruthlessly cutting your old operational costs, the inflation and supply chain realities will just crush your margins.
But, it leaves us with one final, very large variable that all this financial engineering can't easily fix.
What's that?
The filings note that Flowers actively hedges against climate and commodity risks. They currently hold nearly $18.5 million in derivative contracts just trying to lock in the future prices of wheat, soybean oil, and natural gas.
Right, which brings up a critical question for the future of this company. I mean, as climate change introduces extreme physical risks and massive price volatility to those baseline agricultural commodities, will the strategy of buying up premium snack brand actually be enough to protect their margins?
That's the million-dollar question.
And more importantly, what happens when the premium, better-for-you consumer-like, the one paying $7 for a box of Simple Mills crackers, finally hits their own economic breaking point?
If inflation pushes the price of those premium snacks too high.
Exactly. Flowers Foods might find that the shiny new engine they paid $846 million for is just as vulnerable as the legacy bread aisle they are desperately trying to diversify away from.
Now that is something to chew on.
Yeah, definitely.
Well, thank you for joining us on this deep dive. The next time you are standing in the grocery store, I hope you look at the shelves a little differently.
I know I will.
Keep questioning the business models, the debt, and the logistics behind the everyday products in your pantry. There is always a deeper story hiding right there in plain sight.